Hi everyone, and welcome back to FANG Friday. I have been quite delighted actually to receive some feedback from some of our viewers, and in particular this week I got a tweet from Andy Madden who wanted to know, why do the current values of the breakpoints keep changing? Well, I am delighted to answer that question, Andy. So let's turn to Amazon, which is our first stock up. Okay, first of all, you'll notice that there's been a steady growth of the breakpoint values. And the question is, how do we calculate them? Well, what we do is we take the earnings forecast going out 12 months from now, and our program then incorporates those earnings into the balance sheet aggregates here to produce what you might call a new balance sheet, but projected 12 months out. Now, that means, of course, with rising earnings, therefore the fair market value will rise. In the case of Amazon, we note that the earnings forecast and therefore the fair market value, which is this line here, have been kind of flattening out. And with it, the line, the structure line, has been flattening out a bit. It's still growing, but it has been flattening out. Now, there is always a bit of an error factor that we have to admit to in calculating what we would call the current breakpoint value. First of all, there could be stock buybacks, and we have seen that with Apple, that all of a sudden the trajectory of the breakpoints change. There can be write-offs that suddenly causes a decline in book value. There can be a new issue of shares. When you're issuing shares at a very high price to book, of course, you will cause a jump in the average book value per share. And then, of course, there will be such things as option conversions. Anyway, we take these values as given in the on the right-hand side of the line as being rough. And when I say rough, I mean call it plus or minus about 3%. Turns out to be the error factor in the way that we project those lines. We, by the way, have experimented with different ways of calculating this line. We've used the least squares projection. We've used all kinds of stuff. And what we find is that using earnings projections with some AI in our program, which helps to smooth things out, turns out to be about the best projection that we can come up with. Okay. Now, Amazon has been growing at about a 30% per annum rate, but it is slowing down slightly, as you can see from that change in the fair market value lines. Now, the question is, do stock prices, do the structural prices, which by the way are our technical breakpoints, do they only go one way? Well, let's go and take a look at Baytex Energy, and then you can see that the answer is certainly not. Here is a stock where the balance sheet has been falling for 5 years. So the book value per share has been sliding steadily during all of that period. So no, our projections don't only go one way, and furthermore, our AI element of our program make sure that just because we have some positive earnings here showing at least a positive earnings forecast, that we don't suddenly show the lines sort of tilting back up again. That's not what happens. The balance sheet of Baytex continues to fall. Now, one of the questions that sometimes arises is, by the way, where does that fair market value line come from? Well, what we do is we take the earnings forecast 1 year out from now, and then we calculate the fair market value using that value. We've experimented, by the way, with 6 months, 1 year, 2 years, even 5 years. And what we have found out is that the most accurate valuations that we can find, the most accurate prices that we can find occur if we use 1 year numbers. We can, however, we can look at a company like Amazon and we can say, look, well, the fair market value is here, and that's, look at that, it's 69% lower than the current price. Well, how do we account for that? Well, essentially, the market is looking a lot further out than simply 1 year, obviously, to get that number. But we have programs that tell us how far out that the company is actually looking. And what we find out is if the stock market starts to look more than 5 years out, that the risks in the stock start to get out of sight. And therefore, we are very, very cautious about valuations when stock prices get way, way ahead of their fair market value. What we find for senior companies that have been around for a long time is that they tend to peak out at or very close to their fair market value calculation. You can see here with BCE, it peaked out, by the way, precisely there. And the second time after a setback, fairly close to it. Okay, third time, not so close, and then the fourth time, the market sort of like said, forget it. Okay, the fair market value wasn't going anywhere, and frankly, we're sick and tired of being up at the fair market value, and so we got a nice setback in the stock. And indeed, it fell right to the next lower breakpoint and gave us a perfect buy in the stock. This stock is and has been in our model portfolio for some time, and it's had a nice run. But look how close it is getting now to its not only its super growth price, which is 3.5 times book value, as I think I've mentioned many times before, a very, very key level, but it's also getting very, very close to its fair market value. The stock, based on its history, is not going any further than that. One of the things that we can do once we know what the fair market value is, we can also turn that around and calculate what I would call a return on equity, an ROE line. And I do that by just clicking on this little button here, the price to book. And look what happens to IBM, which was kind of a higgledy-piggledy stock when we looked at it on the chart alone. But if we look at it from a ROE point of view, we see a much, much different picture of IBM. For the first few years of this cycle, from 2010 to about 2015, the earnings, the fair market value, and the ROE were all rising. For the next 5 years, they have been falling. In the rising period, then the price to book of IBM rose with it. In the next 5 years, the price to book has been steadily falling. So it's a very, very useful check on whether we can say, oh, well, we really like IBM now because look at the stock's getting very, very cheap. Yeah, but there's a good reason for the stock getting very, very cheap, and that is to say that the ROE has been slipping steadily. And by the way, the latest earnings really underline that quite strongly. Anyway, back to the FANG stocks. Here's a look at Facebook. Remember, we had a breakout a little while ago, and we actually put it into our model portfolio. And well, unfortunately, of course, the breakout didn't hold, and the stock is hanging just around its mid-super growth price. That's 4.5 times book value. If we look at the ROE calculation, however, we see that the stock, at least at the ROE, has been flattening out, and the stock therefore is really not going anywhere. We would suspect that this kind of a drop is something that we can look for in the future, and indeed, since our best buys for investors occur when the stock is at a discount to its fair market value, we are thinking that Facebook maybe has a little bit further to fall than just its fair market value. Alphabet, well, look at same story. Okay, the ROE has been flattening right out at about 15% and pulling the stock down with it. I have said a number of times on our FANG Friday call that I think that Alphabet wants to fall to its super growth price. That's 3.5 times book value, and that's the reason why I say that. Very, very steady, very powerful, and very steady returns from Alphabet, but nonetheless, they are really sort of pulling the stock down to that fair market value calculation. Now here's Netflix, which for a moment seemed to kind of throw us for a bit of a loop. It got down to its HB3 line and actually fell through it. We had a sell on the stock. Let me just bring up the one-year chart. We've had a sell on the stock all the way through, and then it dropped down to its HB3 and actually broke above there again. And looked maybe as if it's got another breakout. However, the ROE tells us that the stock is not particularly going anywhere. And if we take a look at it from a longer point of view, the ROE has flattened right out, leaving the stock kind of suspended in space. We think that that stock has miles to go before it sleeps. And as you can see, with a 70% downside risk, I would be very, very cautious about becoming overly bullish on Netflix. Nvidia, well, we've had some fun with that. We've not liked the stock ever since it was way up here at HB4, and indeed it fell right down to its bubble price. And I have said a number of times that the bubble price, which is 7.4 times book value, is very, very powerful support, and so it has proven to be so far. The issue, of course, with this company is that its ROE has flattened right out, leaving it a little bit suspended in space. How suspended? Well, minus 43% suspended is how. And of course, I've shown you the very long-term chart of this company. It is very, very volatile and very cyclical over long periods of time. Finally, I look at Apple, and here's the stock, which is trading right up, just a little bit above its fair market value. The stock, the company has been buying back stock, and what that does, if we take a look at the ROE, of course, is to boost the ROE. of the company. And so the company right now, the stock is actually trading right up, both at just a bit above its break point, its bubble price, and its fair market value. I kind of suspect that that's about it for Apple, and we have not cared for that stock simply because the longer-term view of this company suggests to us that this is pretty much the maximum that we can expect from there. Knowing that fair market value and the ROE button on our chart can be very, very useful in taking a look at a company like McDonald's. Now, McDonald's has been buying back a lot of stock, and the stock price rose and rose and rose. But let's go and take a look at what's happened to the ROE of this company. You can buy back stock, you can have a negative book value, but of course in structural valuation analysis we do not have such a thing as a negative book value. We actually adjust the book value, and our book value currently suggests that the adjusted book value is about $2 a share. Well, what's happened is that the ROE shot up all right, and of course carried the stock with it. But it has since leveled out, and right now the stock is about 55% overvalued. If anything ever happens to this market, there is a long way down in McDonald's before it finds a safe harbor. Anyway, I hope that to Andy and to other people who are interested in the inner workings, the guts, if you like, of SVA, that this has been a helpful look at the FANGs from a slightly different point of view. At any rate, this is Ross Healy. I am the chairman of Strategic Analysis Corporation and a portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. And I hope that we have showed you some very interesting tools this week. I'll see you next week. Goodbye.